All right, today we're going to break down a really powerful framework for mastering the psychology of investing. And look, this isn't about chasing the next hot stock. Not at all. It's about a simple set of rules to keep you on the right path when your emotions are trying to grab the steering wheel. It's called the 7-5-3-1 rule.
This quote just gets right to the heart of the problem, doesn't it? I mean, think about that. You put in all that time, all that patience, all that waiting, only to give up right before the magic is about to happen. This one idea is exactly why so many investors just don't see the results they're hoping for. They mistake that slow cooking process of compounding for a broken oven.
Now take a look at this number, negative 8.5%. What do you think this could possibly represent? It's not a market crash, it's not some single bad year. It's actually something that happens way more consistently, and frankly, it's something that's way more controllable. That's right. The average person, on average, gives up 8.5% of their potential returns. Not because the market is rigged, but because of what the experts call emotional timing, which, let's be honest, is just a fancy way of saying we buy high when we're excited and we sell low when we're scared. See, the biggest enemy to our portfolio isn't Wall Street. It's our own human nature.
So how do we fight back against our own worst instincts? We need a system, right? A clear, simple framework that basically puts up guardrails for our decisions. And that is exactly what the 7-5-3-1 rule is designed to be. You can think of it as the antidote to that 8.5% emotional gap.
Okay, so let's dive into this. We're going to start with the foundation of the entire rule, which is really all about setting the right expectations right from day one. The very first number you need to just burn into your memory is 7. This number, this is your perspective. It's your timeline. And most importantly, it's your commitment. This is what we call the 7-year floor. You commit to not touching, not judging, not even worrying about your investments for at least 7 years. Now, why 7 years? Because that's typically the time frame you need for that compounding curve to really start bending upwards. It gets you past that initial flat period we were talking about. The one where people get discouraged and they want to turn off the oven. This rule forces you to give your investments the time they actually need to cook. All right, let's move on to the next number and see how this starts to build our resilience. Because once you have the time frame locked down, you need the right tools to weather the storms that are, inevitably going to come along the way. And that brings us to the number 5. Now, this isn't about making things complicated. It's about making things stable. It's about building a portfolio that can actually take a punch. Rule number 5 is all about diversification, spreading your investments across at least 5 different asset classes. So you're thinking things like stocks, bonds, real estate, maybe commodities. By spreading things out, you basically ensure that if one part of the market is having a really bad year, well, another part might be doing great. It's this balance that keeps you from panicking. It just smooths out the ride, and that makes that 7-year journey so much easier to stick with. Okay. Now let's talk about the biggest challenge of all, the enemy within. Because even with the right timeline and the right mix of assets, your own mind can still be your absolute worst enemy. And this brings us to the number 3. This represents the 3 predictable and, let me tell you, highly destructive psychological traps that trip up almost every single investor at some point. Just think of this as a really slippery slope. It always starts with doubt. Is this really working? Then, if the market stays flat for a while, that doubt turns into frustration. I've been putting money in for years and have nothing to show for it. And then finally, when the market takes a dip, frustration just boils over into pure panic. This is that emotional spiral that leads people to sell at the absolute worst possible time. Just recognizing these 3 phases, that's the first step to conquering them.
And this right here just illustrates the choice you have perfectly. On the left, you've got emotional timing, reacting to every headline, selling when you're scared, chasing trends that have already peaked. But on the right, you have discipline, following the plan you set out from the start, staying the course through the choppy waters, and automating your path to growth. This is the battle, and the 7-5-3-1 rule is how you win it.
So, here's the crucial point. How do you make this discipline an automatic habit? How do you turn a good intention into consistent action that builds real, tangible momentum over time? Well, it all comes down to our final number, 1. Just one single, powerful, and repeatable action that you only have to think about once a year. That's it. This is the one annual action. It's so simple. Just once a year, you increase your contribution amount by 5%. That's small enough that you'll barely even feel it. But over decades, this simple, automated habit has a massive impact. It's like turning your compounding machine into a supercharged engine, all while reinforcing your own commitment to the plan. So let's just put it all together. This single slide, this is your entire framework. It's so simple. 7. Commit to that 7-year floor to let compounding do its thing. 5. Diversify across 5 asset classes for resilience. 3. Recognize the 3 emotional phases: doubt, frustration, and panic, so you can avoid them. And 1. Take that one annual action to increase your contribution by 5% and automate your growth. See? It's a complete system for disciplined financial success. And that really just brings us to the final question, doesn't it? After everything we've looked at, it becomes pretty clear that for most of us, the biggest risks and, frankly, the biggest opportunities, they aren't out there in the market. They're staring right back at us in the mirror. Mastering your finances always begins with mastering yourself.